Fiverr and Upwork are two gig economy stocks that have been under pressure because of the rising effectiveness of artificial intelligence and investor concerns that the clients on the platform would use AI instead of going and hiring people on these gig economy platforms. So I'm going to review these two companies and answer which one I think makes the better stock to buy at current market prices. So let's jump in.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So the first thing I wanted to compare these two across is on revenue growth going back several years. And Upwork has increased its revenue from $164 million in 2016 to $773 million in the most recent trailing 12-month period. The company's revenue growth over the last year has been less than what Fiverr has generated in the last year, and also less than what Fiverr has generated over the previous 8 or 9 years. So Upwork's revenue growth rate in this time is good for a compounded annual rate of 20%, while Fiverr's growth rate from 52 million to 419 million is good for a compounded annual growth rate of 32%. So Fiverr's growing its revenue much quicker than Upwork. Fiverr caters to smaller businesses, while Upwork caters to some larger buyers of services, some companies that like to hire in bulk or do more in between, where they're hiring gig economy workers, but they're also kind of onboarding people. So it's kind of an in-between thing. Upwork is more like that, whereas Fiverr focuses more on specific smaller size transactions. Each of them has been increasing the transaction fee they're charging. And as if you've been following my channel, you'll know I like these platform type business models where these businesses don't own anything. They don't own any, or they don't partake in any of the labor and human resource challenges of hiring an employee full time. They just operate the platform that brings together gig economy workers and those folks that want to hire gig economy workers. Similar to how Uber, Lyft, DoorDash, Airbnb, eBay, etc. operate that platform business model. They don't own anything. They just bring together two sides of a transaction and take a fee from transactions on the platform. I like that business model. It's been lucrative across industries, and Upwork and Fiverr operate on that business model, which is one of the things that attracted me to them in the first place. So the next thing I wanted to compare these two on is the return on invested capital. And in the last few years, Upwork has done a great job in boosting this metric. For the longest time, between 2018 and 22, they had been getting worse, right? So negative 4.9% to negative 27%. So that whole time I did not have Upwork rated as a buy, because as you've known, I like companies that are, even if they're not profitable, I like when they're making progress towards profitability. And then in late 22, like many tech companies, they started focusing on profitability and improved their profits up to negative 2.8%, and then of course all the way up to 42 and 45%. So around 2023, when I saw the company improving their metrics, and of course in 2024 I had the stock rated as a buy, and I've had Upwork stock rated as a buy ever since then. Meanwhile, Fiverr has been improving its return on invested capital also, but not as magnificently as Upwork. Fiverr's been focusing a little bit more on top line growth and a little less on benefiting from returns on invested capital. They're still spending on marketing, sales, and customer acquisition, and they have been also raising their fees too, so you'll start to see improvements in return on invested capital as each transaction becomes more profitable. So now let's look at valuation, which I think is attractive for both of these companies. Fiverr is trading at a significant discount, in my opinion. Its intrinsic value per share is $61. Current market price is only $23.51 according to my DCF model. Upwork is intrinsic value at $18.34. Current market price is $17. So also undervalued, but a lot less so when measuring by my DCF. When I go back to fiscal.ai, which is where I'm getting all of these charts, and I look at the forward price to earnings, Fiverr looks cheaper in this metric as well. It's trading at a forward PE of 8.55, which is ridiculously cheap. Again, because of that risk of artificial intelligence, investors are concerned about these two companies. That's why they're trading at such cheap valuations. Normally, companies with this kind of revenue growth and this kind of improvement in profitability metrics, you'll see them trading at much more expensive valuations, but the threats from AI have them trading at really cheap valuations. Upwork also trading at a forward PE of 13. But what I've heard from management teams of each of these companies is that AI is not hurting them so far. In fact, it's actually bringing in more customers and it's improving the services of existing gig economy workers who are utilizing, incorporating artificial intelligence to enhance the services they offer. So far, it's been a lift in their company's revenue, and in terms of customer engagement, it's been increasing. So far, so good. Now, as I mentioned, I have them both rated as a buy, but if I had to pick one of them, it would be close. It would be close, but I would pick Fiverr. I would pick Fiverr as the better one of these two growth stocks to buy now.
Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.